So next we're going to talk about blended finance. And, blended finance over the last few years has been sort of a topic du jour in the broader development finance discussion. And I wrote a piece earlier this year really looking at how, despite a lot of excitement around blended finance, it hasn't necessarily taken off. It hasn't scaled to the degree that folks think it could, folks think it should, to sort of enable it to reach its potential. And so we have a great panel today to talk about what's being done, some of the challenges, how we might address them. And before we kick off, one of the challenges in this space is really that there isn't a single definition on blended finance that everyone agrees to. The Organization for Economic Cooperation and Development, the OECD, has a definition, which is that blended finance is the strategic use of development finance for the mobilization of additional finance towards sustainable development. Whereas the IFC, and we'll hear from the IFC on this panel, defines it as the use of relatively small amounts of concessional donor funds to mitigate specific investment risks and help sort of balance risk-reward profiles of investments. And so, this issue of whether blended finance requires concessionality or not creates some challenges in how we measure and discuss it. So we'll be sure to try to specify as we discuss today in this conversation. And so it's my pleasure to introduce our panelists now. We have Martin Spicer, who's the Director of Blended Finance at the International Finance Corporation. We have Nadia Nikolova, who is the Lead Portfolio Manager for Allianz Development Finance Strategy. We have Laura Sennett, a policy specialist at the UN Capital Development Fund, who focuses on blended finance issues. And hopefully, Admassu Tadesse, the CEO of the Eastern and Southern Africa Trade and Development Bank, will be joining us, but I think he's got a few technical issues that we're trying to work out. So we'll kick off the conversation and bring him in when he's able to join. So, Martin, maybe I'll start with you, because I know you've spent a lot of time thinking about some of these blended finance definitions and have worked with a set of DFIs at IFC to create a set of blended finance principles, which have been out there now to try to create sort of more understanding and a sort of more framework around what blended finance is. And so I wanted to ask you what progress has really been made since those principles were agreed to, and what insights you might be able to share with us from the upcoming Blended Finance Compendium IFC is going to release on how to overcome some of the barriers that we're seeing today and accelerate blended finance.
So thanks a lot, Adva, and thanks for inviting me and IFC to be part of this session. Over 20 different DFIs have signed up to use these, they're called DFI blended finance principles, to filter projects and decide whether or not a project needs the support of the concessional funds. And these DFIs and ourselves define blended finance as the combining of concessional funds into a project with commercial funds, whether those be from a DFI who operates on commercial principles or true private sector investors. And many times these concessional funds are structured in a way to either reduce the cost of funding to allow a project to go forward because of the buying power of a consumer. Maybe it's a power project that needs to obtain a certain end tariff for users for affordability issues. Or blended finance is structured to de-risk and help improve the risk profile for an IFC or for an Allianz to come in, so that it meets that particular commercial investor's risk-reward profile. And this is what one of the principles, which is minimizing concessionality, is trying to find what is that level of concessionality or subsidy that is the minimal amount in the structuring of an investment to de-risk or rebalance risk return. And just if we look at IFC's investments over the last 10 years, we've used about $1.6 billion of concessional funds to support IFC. And this has helped IFC invest over $6 billion of its own account and crowded in over $7 billion from others. And just last year, we committed 500 million of that 1.6 billion. So the ramp up, at least from our perspective and what we're seeing from other DFIs, is there's an increasing use of these concessional funds to support our own activities. And the challenge is continually justifying the economic rationale too, is we're trying to help create markets and not distort. And so besides the structuring element, having an economic rationale, a market failure that needs to be corrected, and that's related to both the impact that the project could have, as well as the additionality that a DFI brings that provides financing at longer term than might be otherwise available in a less developed country. Thanks.
Yeah. And Laura, I wanted to turn to you. One concern that's often been raised is that as we look at blended finance deals and we look at when concessional capital is put into play, we're still not seeing as much of that in least developed countries. If you look across portfolios, the research that's been done has shown that most of it, in fact, is going to higher income countries. And so I know this is something that you work on a lot at UNCDF. I know there's an upcoming report with OECD coming out, but what do you think is needed to ensure, and as DFIs are doing this sort of accounting of when and how should we use our limited concessional capital, what can be done to ensure that it's going to least developed countries, low income countries?
Great, thanks Adva. Thanks for having me and UNCDF here today. Yes, indeed, at UNCDF, we focus on the world's least developed countries, or LDCs. And so we are looking at this very closely. As you mentioned, we have an upcoming report with the OECD. It's our third report on the topic of blended finance in the world's least developed countries. And the data shows, again, that only 6% of private sector finance mobilize is going to the world's least developed countries. So it's a very small percentage of that finance going to where it is potentially needed most. Some of the issues, of course, are the risks that Martin's already mentioning about that need to mitigate some of the risks. And there's a long list of risks that in the LDC, some of these markets are just not ready for certain issues, such as sponsor capacity, the size of the deals, the development of the private sector market in that country, the high cost of capital in these markets. The list goes on, and we can, of course, talk more about that. But the question then becomes, what can we do to mitigate some of these risks to make sure that we can get some of this finance to the world's LDCs? There are a number of different ideas out there that are being sort of talked about right now. At UNCDF, we take really an investment continuum approach. So some of our work is actually in grants and technical assistance and capacity building in order to get projects ready for finance. And we're able to then take them from that stage to then give them concessional loans and guarantees on our own balance sheet as well. And then after that, we've set up 2 different third-party managed funds that can provide even larger ticket size, semi-commercial loans and some potential equity as well. And so by preparing those projects and creating a pipeline, we find that we're able to really catalyze additional finance into these projects. There are other suggestions made by Convergence Finance, which is very big in the blended finance field, that they really advocate for a portfolio approach. That one of the issues in LDCs is that the ticket size is too small and the projects are just so small that the cost of doing these projects is so high, it's not worth it, given the risk and the potential return. So by taking a portfolio approach, aggregating a number of projects or syndicating a number of them, that you can somehow raise this and that it makes it more interesting for investors. And another thing that Rémi mentioned from the Agence Française de Développement is the role of the national development banks in these countries. They have a really unique position in that they know the context of their countries really well. They're able to lend in local currency, which is really important for, which is another risk, sort of the currency exchange risk in LDCs. But as Rémi mentioned, these institutions need to have a really strong governance structure and need to be properly financed and able to play a larger role in this space.
Oops, I was muted. Nadia, thank you, Laura. Nadia, I want to turn to you next. I think one of the things that's often talked about in the development community is the challenge of getting institutional investors to participate in development finance. And so, Allianz is an institutional investor. You invest in this space. So tell us a little bit about how you've been able to do so, how those efforts can be scaled, and what you see as the role of international financial institutions and development finance institutions in enabling institutional investors to come in.
And thank you for having me here. I'll actually continue on the thoughts that Lara was going. We very much lay with a convergence of this world where we think portfolios are the ways to go about it. We manage more than 1.8 billion of blended finance commitments out of Allianz, and the way we've managed to scale to that number is really where we've been looking to blend at a portfolio level rather than individual project. I think a lot of the work has gone on individual projects where a lot more blending is required to get investors comfortable with all the risks that Lara went into detail with. Which means that one, we require a lot more capital. Two, individual investors don't necessarily have the resources to analyze individual projects in specific countries. So I think there are basically three reasons why we don't see blended finance having kicked off tremendously. One is lack of track record. Most of us talk about perceived risk being higher than actual risk. Unfortunately, the GEMS database, which I think is one of the biggest impact achievements if it ever happens, if it were to be published, has not been published. So institutional investors are told, yes, emerging markets are not that risky. But
tell us what the GEMS database is, just in case people don't know what it is.
The GEMS database is basically most of the development banks' historic track record, their losses, their experiences in general, whether that's from a profit perspective or an actual net loss perspective. And in every new asset class, if you're trying to crowd in institutional capital, you need to be able to quantify the risks in order to know how to price that risk. And so long as that database is not out there, it will be very challenging to crowd in institutional capital. A lot more blending would be required in order to mitigate the risk that we actually are not able to quantify. The second issue that I see in these markets is one of incentives, and Catherine talked about it in the previous session. I think my favorite thing in the world is a capital-starved development bank, and I keep on saying that IFC was the most innovative of its states I found at the times before the last capital injection. That's when we did the MCPP program. That's when they started issuing large-scale green bonds. It gives different types of incentive in order to crowd in capital. And the third one is education, and we touched upon this earlier again. It is communicating in the same language. Understanding who can contribute what in the system. And I think we haven't managed that quite well yet, but we are making very, very good progress. The mere fact that you have public and private people on this panel in itself is something that wouldn't have had a few years ago.
Great, thanks, Nadia. And we'll probably come back to some of these issues in a little bit more detail. One question I did have for all of you is, we're in this moment where COVID has sort of upended a lot of what we're doing in this world. And so I'm curious how you've seen COVID impact blended finance efforts. We're certainly seeing, pressure on development and aid budgets and on that concessional capital. And so I think folks will naturally have questions about whether that should, be given as direct grants, whether it should be used to crowd in private sector. And so I'm curious what you've seen as the impacts so far in terms of COVID-19, whether there's an opportunity, what some of the potential challenges are today. And Martin, maybe we'll go to you first, and hopefully we can sort of go rapid fire to each of you to get your thoughts.
So thanks, Adva. Yeah, soon after March, IFC pivoted to address the COVID crisis among our clients and set up about $8 billion of facilities to do that. About $4 billion have now been committed. And what we did with blended finance is help support the effort to continue investing by IFC in IDA and fragile, like low income and fragile countries. So that's how we've used blended finances to keep IFC's mainstream focus on the less developed countries, because without the de-risking, IFC by its nature and trying to ensure continued financial stability would have stayed with middle income, less risky investments. And so of that 500 million I mentioned earlier that we committed last year, about 250 was actually devoted to these portfolio type of facilities that Nadia mentioned for working capital and for trade finance as a way to quickly deploy and in a sort of emergency situation, IFC's funds supported by the blended finance. Thanks.
Laura, you want to jump in?
Sure. Yeah, I mean, that's definitely what we've seen in the research we've been doing for this report that I mentioned is coming out in December. There's been obviously a massive outflow of private capital, and it sort of halted the FDI inflows into the LDCs in particular that we've been looking at. And as Martin mentioned, you know, the research shows, and from interviews and everything that's been done, you know, the DFIs are supporting their own portfolio right now. So some of the questions that are out there are, number one, it's hard to tell if some of the amounts that have been announced are actually new capital or if it's been repurposed from other projects. And then so far we've seen in the short term, at least, that it's really been about addressing the existing portfolio rather than doing new blended finance projects, which we think is probably understandable given the short and immediate term needs that were there. And so we've been looking now at thinking, okay, in the more medium to long term, what can be done? And a recommendation that we have is that we need to make sure that a sustainable, resilient pipeline is being built right now, so that when that time is ready for these new investments to come through, that they are promoting a economy and a society that is more resilient and more able to sustain the next shock. I'm sure that you've heard that the UN Secretary General has called for building back better. And so it is in that idea that we need to make sure that we can prevent or help be able more ready to respond to future disasters and shocks.
Great. Admassu, I think we have you on the line now. So I want to turn to you and both hear from you about what you see as the impacts of COVID-19, but also wanted to ask you this question about helping to mobilize institutional investors and particularly local investors. I know it's something you've been able to do at TDB, both in your investment vehicles, but also in how you're structured. So if you could talk to us a little bit about how you've managed to do that, how you overcome some of those barriers, and what the impacts of COVID-19 have been, that would be great. You are muted.
I hope you can hear me now. Excellent. Sorry about the technical difficulties. The Wi-Fi was very weak. Yeah, TDB, as you've noted, has had quite a bit of success in crowding in private capital, specifically institutional capital, into not just transactions, but also into special purpose funds and into our own capital structure as a bank. We really reached out to pension funds and insurance companies, tried to give them that confidence that coming into transactions alone wasn't going to give them the diversification that they needed sometimes. So what we felt was if we opened up our total portfolio to them through a capital investment in a specific segment of our capital structure, that would give them the comfort that they would be benefiting from both diversification, but also, of course, the comfort of having a multilateral wrap around their capital. So this is a little bit of an innovative approach that we've taken as a regional DFI. And of course, we've made sure that we gave them a risk return value proposition that was attractive enough to get them to come in. And we've had almost 12 different institutional investors now come in. Most of them are local, and they've actually been quite pleased. Several of them have recapitalized their dividends, and they've actually managed to help introduce other institutional investors to come in as well. So that's really in broad strokes what we've managed to do.
And I guess building off of that, Admassu, so you've managed to do that. A lot of people are trying to sort of crack the nut and figure out how to do more of that. So when you look at trying to mobilize more institutional investors, or bring them into your business, bring them into some of these deals, what advice would you have for folks who are trying to do this?
Well, I think first of all, what becomes very clear is the value proposition has to be in line with what institutional investors are looking for. And then, of course, there needs to be track record, because I think sometimes what happens is there's a lot of advocacy that goes on, but then it's not very easy to follow through. So what we've done is we managed to bring one or two in to start, and when we use them as our ambassadors, because we demonstrated what we were able to deliver to those specific early stage investors. But what we also managed to do is to get the sovereigns and the original classical owners of our bank to create room for institutional investors, to create board seats for them, and to allow them to participate and get that blended return and risk exposure in a manner that gave them that confidence that they're real participants in the institutional model. And I think that really helped them come through, because they discovered that having a seat on the board and having a full level of participation in our governance structures gave them that additional confidence.
Great, thanks. Another question I wanted to turn to, which I think is, a strong debate that goes on, is, when is blended finance the right solution and when is it not? When is it sort of what we're supposed to finance? And Nadia, maybe I'll turn to you first on this. Where do you think blended finance can and should be deployed?
Blended finance is a great solution when you have market inefficiencies. So in the clear example that you're hearing, I think one after the other, is where we have perceived risk and actual risk being different, the knowledge, the lack of track record. Where you have a lack of track record is where you really need lending. The more track record you have, the more you have the ability to price in risk. It is not that institutional investors don't want to be in emerging markets, and in the least developed markets, they don't know how to price it, or they price it at a level at which the projects just don't work. So the more we have lack of track record, the more blending we would need. I think over time, what we'll see is that what we see at the moment at the portfolio level, having equity investors coming on, first loss investors coming in, over time, maybe a different type of investors are going to be coming in. Rather than donor capital, maybe we will see hedge funds or family offices or other type of impact investors that come into this rather than public capital. So blending when we don't have a track record.
Great. Laura, do you want to jump in on this one too?
Yeah, absolutely. I love this question. This is something that I'm a huge fan of blended finance and love talking about and writing about, but I don't think it's like a panacea for all development finance projects. Martin mentioned this already. You need to make sure that you are achieving the minimum concessionality, that you are not crowding out the private sector, that you are not distorting the existing market. So that means that there's a place where it's not the right tool. And we also know that ODA is, or overseas development assistance, is finite. There's a limited amount of this scarce, important concessional resource, finite and perhaps even declining in some places. And so it needs to be used in the smartest way possible. So with that in mind, I think this is sort of another way of looking at the portfolio approach, is that donors who have this really important concessional finance think across all of their investments, where can they actually get the most impact for the use of their concessional finance. And it might be true that the pure concessional in a grant might be needed somewhere, and that's where that should be used. And then blended finance should actually be a different project somewhere else, and that you don't want to actually confuse the two. And so it definitely takes a lot of analysis of these projects, but I think that, as Nadia mentioned, one of the risks in terms of track record is very important. And there are others, but again, I think that there's definitely a time and a place.
Great. Martin, do you want to jump in on this one too?
Yeah, thanks. This is the core question. And to reiterate, market inefficiencies, those could also be related to externalities that aren't captured by a project. And historically, climate, renewable energy received a lot of blended finance. Today, people are talking about using it for battery storage projects. The other is in countries where there aren't really well-developed markets, and that's the less developed countries. And so blended finance structures or facilities that focus on those markets, like the IDA private sector window, is another way to ensure that funds are being used properly. But even in a less developed country, you might have some with more developed markets than the others. So you do need to try and differentiate. And just to add, when should one not use? And I was having a conversation with my team earlier today, where it seemed like our investment colleagues wanted to try and provide financing to a client that met the client's needs and other sources of financing that were available in that market. So we should not be using blended finance to help compete into a project where there's available funding. And we use that word market distortion as a way to talk about that, but that's what it is, and we should not be doing that.
Great. I want to be sure that we bring in some of the questions that have come in from our audience. And we have quite a few questions sort of about how to make blended finance work, particularly in LDCs. But one of the questions that we got is, that often blended finance vehicles are looking for investments in large companies, including in LDCs. And so the question that we have is there a way to sort of tailor blended finance tools to SMEs, to these small and medium enterprises? And I don't know, Nadia, do you want to jump in on that one?
And one of the best ways we have seen it is working with local financial institutions who then channel in the funds to these entities. From an institutional investor perspective, the best place to be is on the ground, and those financial institutions are on the ground. You can have purpose proceeds and so on and so forth to make sure that this money are channeled in that way, and then monitor. That's the best solution that we have found, that we blend at our fund level so that we ensure that we invested in many financial institutions on a portfolio basis, that then has a portfolio of SMEs, and we monitor the performance of those.
Great. And to follow up, we had a question that was really asking about, is there already sort of a proven way to build out portfolios of those small companies? Or do you see a need for more research on how to create sort of those portfolios of small companies? Martin, did you want to jump in?
Yeah, so we've developed a couple of years ago what we call small loan guarantee program, using funds from IDA as a first loss structure. And we've already got over a dozen, almost 24 risk-sharing facilities that IFC has set up with a number of banks, mostly across Africa, but in Haiti and in Asia, trying to do exactly what Nadia said, and I agree completely with her, is for these SMEs, local institutions or microfinance institutions are the medium through which one can address the problem. And these first loss guarantee structures are ways to help de-risk the provider of a guarantee, the risk share facility like an IFC, but many others do this similar structure. And we're still learning, so this seems to work. It seems to encourage financial institutions to lend. What we're seeing today in the COVID crisis, though, banks are quite liquid and are unwilling to take the risk of SMEs. And we're hoping that this product can help with that flow. So it's not a funding need, but more a risk mitigation kind of structure.
Great. And we had one question come in following up on when Nadia was talking about the GEMS database earlier. And that question is really, what are the blocks to that? IFC, I believe, participates in the GEMS database. So, what would it take for IFC to go in and advocate for the GEMS database to open up? Are you willing to, share more of that information and your track record so you can crowd in other investors?
So let me say, with respect to the topic of transparency of information, it's very important. And on the topic of blended finance, IFC is the one of very few institutions disclosing on our public website when we use blended finance and the level of subsidy. So every single project that's supported by blended finance, you can now sort on our disclosure page by projects supported by blended finance, and you can see the level of subsidy. I'm not so familiar with the GEMS topic and issues behind that, but transparency is important. I agree with Nadia, and it helps reduce perceptions of risk.
Great. And
if I may, I would just add the importance of transparency also goes to the previous points on track record, because as there's more and more transparent data available about existing investments, whether they've been wildly successful or less so, that will show the impact, which shows the track record and that these are actually can be good investments and sort of like a demonstration effect, but also then is the track record that's needed to sometimes incentivize investors to come in.
Great. We've got a few minutes left, but Admassu, I want to come back to you. We had a question come in about integration between global financial institutions and regional and local financial institutions. I know you're, quite involved on the African continent with local DFIs and trying to strengthen and, looking at how they can be strengthened. And so I'm curious, how you think global financial institutions can be better integrated, what sort of support local DFIs need in order to, help accelerate blended finance and sort of do their jobs better.
Yeah, well, I really wanted to just point out that for the first time this year, we have managed to bring on board a global institution. I think Martin is here. I think the World Bank Group came through to partner with TDB in a way that's never happened before. Many of the big global institutions don't seem to historically have had much appetite to work with regional and national or subnational DFIs. So with this year, we actually began a very exciting program, both with the IDA window of the World Bank, but also with MIGA. And MIGA was able to give us a special product that enabled us to actually raise money from the capital markets, actually from the banking markets, right in the heart of COVID. And that was something that was very useful to us because it was a kind of capital raising, fundraising that would not have been possible to the same quality of the fundraising that we managed to do. So I think there is now more and more examples. Work very well with the KfWs, with the AFDs of this world, the European investment banks, but those are classical credit lines. I think what we need to see is some of these very interesting concessional pools of funding being opened up to African financial institutions who can actually also extend their reach to the last mile, push out the tenor, but also take a little bit more risk and not have all these big global funds and regional funds within Europe just being held by one or two institutions, because that really limits the ability to intermediate that type of special purpose funding. So we're beginning to see some movement in that regard, but I think there is a need for a little bit more flexibility in those funds. An example would be the EU Infrastructure Trust Fund. It's a very large fund, for instance, that is being used in some ways to blend, but also to deal with some of the rigidities and the gaps in terms of getting projects prepared and getting the feasibilities out and all of that. So I don't think we've had enough access to those types of funds. And I think as everybody starts putting more premium on the last mile, I think that there needs to be a lot more appetite to work with regional and national institutions to actually leverage this kind of money.
Great. So we've got 1 minute left. So I want to go just really quick to each of you. What is one thing that you think needs to be done for blended finance to be scaled? Nadia, let's go to you first.
Disclose the GEMS database.
Laura?
Keep the focus on the last mile with regard to the risks that needs to be mitigated as well.
Great. Martin?
Transparency on the level of subsidy when used with blended finance.
Admassu?
Open up the pools of funding to the last mile players like TDB and the national development banks.
Great. Well, thank you all so much. This has been a great conversation. There's obviously lots of room to keep the conversation going. And I know I'll be in touch with all of you moving forward as all of this develops. So thank you all again for joining us.